Okay. Oh, yeah. Okay. There's the lighting better. Okay. Camera had to adjust. Welcome back to Accounting 410, Taxes. Volume 2, Chapter 9, Volume 2. I apologize, but when I was doing the first first taping, all of a sudden I lost my internet connection, so technical difficulties will arise from time to time. Best I can tell, we're right around page 922, 9-23, talking about deductions for items that are accrued. Okay. Generally, when an accrual method, the taxpayer incurs an expense, they account for it by, debiting the expense, crediting the liability account, or by crediting cash if the expense is paid. Sometimes the amount of the expense is estimated, like warranty expense. Well, guess what the IRS says? Uh, Typically, estimated expenses result in a reserve account, which can be described as a contingent liability. To claim a deduction for tax purposes for an accrued expense, the expense must meet two tests: the all events test and the economic performance test. Okay, the all events test is for recognizing deductions, is similar to the all events test for recognizing income. That is, the event that established the liability giving rise to the deduction must have occurred, and the amount of the liability must be determinable with reasonable accuracy. However, the additional economic performance requirement makes the deduction recognition rules more stringent than the income recognition rules. As a result, businesses are generally prohibited from deducting estimated expenses or reserves. In other words, economic performance must have occurred for a business to claim a deduction. So it pretty much has to be paid. Okay. I'll give you an example there. Example 9-21. Economic performance. Even when a business meets the all events test, they must still clear the economic performance hurdle to recognize a taxable deduction or a tax deduction. Okay. The delay in payment reduced the real present value of the cost of the deduction. Okay, this requirement specifies the business cannot deduct an expense until the underlying activity generating the associated liability has occurred. Okay, thus, an accrual-based taxpayer is not allowed to deduct a prepaid business expense, even if it qualifies to do so under the 12-month rule, unless it has also met the economic performance test. Again, this is to sort of guard against people from loading up on prepaid expenses to lower their income in a given year, especially if the following year rates are going to change. They're going to want to take advantage of the situation. So the IRS puts these rules in place to negate such strategies. The key facts: you have 3 bullets. Both all events and economic performance tests are required for deducting accrued expenses. The all events test requires the events that establish liability giving rise to the expense must have occurred, and the amount of the liability must be determinable with reasonable accuracy. Economic performance generally requires the underlying activity generating the liability has occurred in order for the associated expense to be deductible. Specific requirements for the economic performance test differ based on whether the liability has arisen from receiving goods or services from another person, use of property, either renting or leasing from another person, providing goods or services to another person, or certain activities creating payment liabilities. And then they go on to explain each one of those one by one in the next several paragraphs with pertinent examples given. Categories of payment liabilities. Once occurs when the taxpayer pays liabilities with this Exhibit 9.2, calling your attention to it. Workers' compensation, tort, breach of contract, or violations of law. Rebates and refunds, awards, prizes, and jackpots, insurance, warranties, and service contracts provided to the business. Note, this relates to insurance, warranties, and product service contracts that cover the taxpayer and not a warranty that the taxpayer provides to others. Okay. That would be a revenue. We're talking the expense or deduction side. Taxes and other liabilities not provided for elsewhere. Okay, oftentimes we have these payments are recurring items, and they're allowed to be deducted immediately, the prepayment, subject to the 12-month rule for prepaid expenses. Okay. I'll give you some examples there in Exhibit 9.3, and then the recurring item exception, okay, because it'll be a wash. Recurring items in an election under economic performance to currently deduct an accrued liability if the liability is expected to persist in the future and either it is not material or a current deduction better matches the revenue. All right, bad debt expense. The tax purposes, businesses determine what specific debts are uncollectible. They are entitled to a deduction. So this method of determining bad debt expense for tax purposes is called the direct write-off method, contrary to what we do for financial accounting using the allowance method. Again, the allowance method is an estimate. So you have a aspect there of can it be reasonably determined? Well, that's subject to debate. So the IRS is not until you know which one has gone bad, and even though it could be years later, depending on if it's a long-term contract or what have you, or just tied up in a bankruptcy case or something, and you can deduct it once it's identified using the direct write-off method. So again, even if you're on the accrual basis, they're reverting on some things back to the cash basis. Limitations on accrual to prevent businesses and related parties from working together to defer taxes. Tax law prevents accrual method businesses from accruing and deducting an expense for a liability owed to a related party. Family members, including parents, siblings, and spouses, shareholders, and C corps when the shareholder owns more than 50% of the corporation's stock, and owners of a partnership and S corporation, no matter the ownership percentages, are considered related parties, related persons. Comparison of accrual and cash methods. They give you a summary there in Exhibit 9.4. And the important things are, just to get familiar with them. They give an example of the cash and accrual basis for the Green Acres. And again, income is the same. The landscape, December landscape services, deferred. So prepaid ones, when you get receipt, it's taxable. Tree sales, so again, gross profit, slight difference there, 4% or so, 3-4%. Then the expenses, there should be a little difference there. Yeah, again, $3,000 difference. So look at the impact on the little difference on the revenue and a little difference on the expenses. Added together, you get quite a bit of difference, 8,000 versus 15,000. Exhibit 9.6. This is the Schedule C that I alluded to in the earlier video. And this is how a proprietorship, a single owner business reports their revenues and expenses. And then the amount that flows from this form goes over to their personal 1040. The first part there is the demographics, name, social security number, the name of the business, location, and a code. For business code, they have a big long list of different codes for all types of business, and then they have the ubiquitous 99999 for other ones that aren't listed. Part 1 is for the income, revenues, and notice the cost of goods sold is in there to go determine gross profit. Then we have part 2, which are all the expenses, lines 8 through 27B. And 27A and B are, other that'll come on the back of that form. Things that aren't listed here. The lines 8 through 28 are the things that you'll see in 99% of the businesses. You take a look at them: depreciation, commissions, vehicle expenses, interest, insurance, mortgage, office expense, rent, repairs, maintenance, supplies, taxes, utilities, and 28 wages. And then you get the total expenses, take that from the total revenues, and that line 31, net profit or loss. It says enter here, and on line 3 of Form 1041, line Schedule 1, line 3 of Form 1040. 1041 is a fiduciary return. If a state return if somebody passes away. Adopting an accounting method. Okay, saw cash, accrual, and hybrid, and generally must select the accounting method that gives an accurate portrayal or a true portrayal of your revenues and deductions. Okay. When the business technically adopts a method, it depends whether it's permissible accounting method or an impermissible accounting method. What do those mean? Permissible is allowed under tax law and are adopted first time they file a return. They must continue to do that or get written permission to change. Impermissible is one that is not allowed by the tax law. And again, it's basically going to be the cash or accrual basis, hybrid basis. Yeah, they give you examples of some people that mix. That would be the hybrid. They give an example there at the last end of that paragraph there, using the allowance method instead of the direct write-off method. Changing accounting methods. Sometimes you might have to adjust the basis of certain assets. You do it using Form 3115. The IRS automatically approves certain types of accounting method changes, but others must provide a good business reason for the change and pay a fee. Also, when you require permission when you change from using an impermissible method to a permissible one. Okay. Tax consequence of accounting change in accounting methods. They call it a Section 481 adjustment. It prevents a duplication or omission of items. Again, you're talking a lot of stuff there with depreciation, cost recovery, and stepped up basis or deflated, depreciated basis of certain assets. And what they do is they will do that over evenly a 4-year averaging to not have a dramatic impact of having the change all in the year of the change. So it's a income averaging thing over 4 years. All right, that about does it, because I'm at the conclusion. So almost made it on the first tape if it wasn't due to the failure of technology at the house here and losing my internet connection. You would have had one tape of an hour and 20 minutes or so. Now you're going to have a long one and a short one. My apologies for that.